So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I am joined today by Sean Katona. Sean is a full-time real estate investor and landlord who has spearheaded 75 plus deals, ranging from value-add renovations to new construction. His focus at Simplified Properties is revitalizing fixer-upper shopping centers to maximize returns for friends and colleagues who invest alongside them. Sean, welcome to the show.
Great to be with you.
Absolutely. Very excited for the conversation. Like I mentioned, we don't talk too much retail, so shopping centers, so this will be fun, but let's go all the way to the very beginning. How did you get into all of this?
Let's see, what got me rolling on real estate was Rich Dad, Poor Dad. I think like so many people, I think I picked up that book at 18 and I was like, all right, let's do this. Let's become a millionaire. And I put it down for a lot of years, but maybe, let's see, I was probably 25 when I bought my first rental house that was cash flow negative, screwed everything up that you could, accidentally like fumbled into a profitable flip and kind of was, enlightened that, hey, I could do a couple of these a year and maybe replace my Microsoft income. And so, that journey kind of chugged along for a couple of years slowly, but finally hired, coach and a mentor to kind of show me the ropes and got going full time at it in 2013. So fast forward about a decade, today my core focus, like you said, is buying fixer upper commercial real estate, pretty much in greater Phoenix. I just got on a roll there. And so I'm doubling down on what's a pretty hot market in a landlord friendly state with, good cash on cash returns, good appreciation. It kind of checks all the boxes and I can fly there from Huntington Beach in about an hour, do a day trip, go every other month, every month as needed when stuff's popping up that warrants my attention there.
Awesome. I love it. So what in 2013 struck you about Phoenix?
Actually, I didn't hit on Phoenix until 2017. So that's when I closed my first commercial deal. I'm originally from Seattle, but ironically moved with Microsoft down to Santa Monica. And so I've kind of been doing this West Coast crawl and tour. And I was actually doing deals in both markets. So both Seattle, Southern California, we bought a couple rentals in Texas. And so I looked across the West for commercial real estate at all different asset classes and all these different geographies. And, it was like the jack of all trades, master of none. And I actually really struggled to find a good deal because it's too hard to underwrite that many markets and that many asset classes with a lot of accuracy. And so finally I niched down a little bit more. And that's what I think got me rolling a little bit better, was say, hey, let's pick retail and let's pick greater Phoenix and let's get to know the players in town there and the numbers and the tenants and, where the demand is and what the good pockets are and the bad pockets are. So what have I done? About 8 deals there now in the last couple of years that, range from 7,000 to 20 something thousand square feet, a lot of high vacancy, value add stuff that, might spook other people, but I feel like has, some of the risk mitigated because we're buying it right, way below replacement costs in markets with, leasability. And so I go in there, force appreciation of those buildings, increase the value. And in some cases we can double the value of a property in a year or so.
I love that. That's awesome. So I want to get into that, but just real quick, touch on what struck you about, these value add retail, basically.
Maybe you'd say it started in single family and residential because, you're taught, by all the gurus out there, go buy fixer uppers and, renovate them and turn around them and sell them for a nice profit. So that same broad idea still holds true in commercial. And I'm just able to really juice the numbers a lot better. So some folks will go out and, pay a 5 or a 6 cap for an apartment building. I might buy one of these deals almost completely vacant where the cap rate is almost irrelevant. But by the time we leased it up, fix it up, I could be sitting on a 9, 10, 11, 12 cap effective with, well into the 20% cash on cash return, not counting some of the principal pay down, some of the tax advantages, some of the bumps in rent that are built into commercial leases. And so when I look at all those things and the numbers, and I looked at the other asset classes and the other markets, I go, wow, this almost feels like a no-brainer. And so that helped me to transition out of residential to do fewer, bigger deals with 7-figure paydays, or that could throw off 6 figures of cash flow in a single transaction versus, at the time I was managing like 15 residential flips, and I was just losing my mind, like an adult babysitter and construction and all the drama and all the hard money loans that went along with that. I was going crazy and just not making as much or taking home as much as I had hoped. And it certainly wasn't a passive income business like I think so many of us envision or look for when we're getting started in real estate investing.
Absolutely. Yeah. And that's kind of a very common thing amongst those of us who get into this, or, well, I didn't start in any form in residential, but very common where that scalability, economies of scale comes into play, and you realize it's just really not there in, the amount of work that you're doing, not equaling, the profits. So now let's get in. Go ahead.
No, I was just going to say, you do the math, the listeners do the math. I did the math. I was like, wait a minute, for like a meaningful amount of income, I'm going to need to own 30 or 40 or 50 rental houses versus doing 2 deals to kind of get to the same place. So like, once you understand that, get comfortable with the bigger deals and the commercial platform, it almost feels like a no-brainer, right? That makes more than sense. It makes dollars.
I love that. It's so true. And so many people think or thought that, commercial real estate was like big boys club and like, this is what you graduate to, but you guys, that's not true. Sure, there's some more variables at play and some more things you need to understand, but once you understand it, you realize anybody can do this. If I can do this, I promise you guys can do it too. So, and that's so cliche to say. And every time I listen to a podcast and someone said that, I'm like, yeah, okay. And now I'm in it and I'm like, oh yeah, okay. Makes sense. So let's get into these deals then. Okay, so you acquire it. It's nearly vacant. What is the value add process look like?
Yeah, so for the retail deals that I've worked on, they're usually pretty tired. And I even say that to my brokers. I'm like, hey, when you're bringing me a deal or presenting something, like, show me the problems with it that we're going to go in and solve and fix. And like, how are we going to be able to justify buying this deal at a deep discount to the current ownership group if it's shiny and pretty and completely leased up and lendable? And so I'm looking for the opposite of that. Basically, it's falling apart. It hasn't been painted. The parking lot's all cracked. The signage is horrible. The landscaping is overgrown. It's, high vacancy or completely vacant. The suites around the shopping center look horrible. They don't show well. You have a mediocre, maybe leasing team on it. You have a landlord who isn't interested in investing into the building or investing alongside the tenants and like tenant improvement allowance, for example, or is being kind of stingy with commission. All those things, or some combination thereof, can lead to properties that are grossly underperforming their potential. And so when I see those, I go, hey, I know how to fix a lot of these problems. I like doing some fun things with marketing. I like getting the properties looking really good. Immediately after closing, we want to go do some things to really make the exterior pop. Oftentimes I'll order a new monument sign, that's just popping and well lit and new signage. And so something that looks circa 80s immediately feels like, hey, this is, 2022 quality construction, new build, modern color schemes. And the neighborhood feels that, the leasing community feels that, the prospective tenants or business owners see that and feel that. And so you go out there and message that to the marketplace and say, hey, new ownership group in town, local property management here. Not that that's me, but you get the idea. And so, hey, someone's going, okay, I'm now reconsidering this building for the first time in maybe over a decade because it's looked pretty tired for a long, long time. And go do those things. We can sign new leases with new tenants or renew existing tenants and bring a building from, nearly completely vacant to fully occupied in some cases, in a year or so, if we're really moving along swiftly.
Wow. That's awesome. So what are some of, I guess pre-COVID, did you have anything where you're like, I want to anchored with this, like anchored with a certain type of tenant, or did COVID kind of teach you that we need like an essential, you know, tenant in there to
Yeah.
kind of anchor it?
I mean, probably most people's favorite is the grocery anchored shopping center. So, when you see a big Safeway or an Albertsons or something like that, folks are going in there every week to replenish their groceries. And so all those surrounding businesses and nail salons and preschools and gyms and this, that, and the other benefit from that consistent foot traffic. You'll see those guys at, busy intersections where you have 30, 40, 50,000 cars a day in the middle of a ton of rooftop density. And so those are kind of the must-haves that I would look at when I'm buying a building. It's like, great, if you buy a vacant building with all the wrong fundamentals, you're going to have a really hard time backfilling it, forcing the appreciation to a property. So say, hey, it's got to have these fundamentals. I'm not going to be able to change where it's at. I'm not going to be able to, change how many people live in that neighborhood, certainly not quickly. But those things that we talked about earlier could all be addressed. And that's more of an ownership decision, or maybe a lack of willingness to spend the time or the money to invest in the property in a way that's going to make it realize its full potential. But I've done a lot of deals that are strip centers or neighborhood centers, unanchored centers, mom and pop centers, and those have been good to me. I've been able to increase the value in many of those buildings by 50 to 100%.
Wow.
And some investors wouldn't consider those types of deals because they're not name brand tenants, because they're not grocery anchored, because they make them feel a little less comfortable with it. But to me, that's where, tremendous value can be realized if you can go in and solve those problems in deals like that.
Absolutely. Couldn't agree more. It's kind of along the same lines as development right now. A lot of upside, but huge risk. So during COVID, did you have to withhold distributions just to kind of play it safe, or, were you guys pretty safe in that area?
It was wild. We had a gym go out in our Albertsons anchored center, but I feel like that guy was nearing retirement and kind of was the perfect reason to send in the keys. But we got them backfilled eventually. PPP worked shockingly well for all of our tenants. It's like, hey, after a month or two, they kind of got caught up, or some of them, were doing fine anyway. A lot of the banks worked with landlords, and so I'm sitting here waiting for these major distressed deals or blood in the streets where I can come in and solve problems and buy stuff at pennies on the dollar. And I just never saw that happen. And I asked dozens of brokers in Phoenix for a year straight, like, where's the deals? Where's the deals? And they just never seemed to come. In fact, if anything, it's like all that money was injected and the interest rates got so low that things went the opposite direction. It got insane and like record-breaking price per foot, record-breaking cap rates, and everyone just, scrambling to find fixed hard assets to buy to hedge against inflation. I was like, man, the opposite happened here. And I went and sold a couple properties for way more than I ever thought they'd be worth. And maybe that'll prove to be, nailing it on a timing standpoint. And maybe we go back and buy those properties again as interest rates climb up to 5 or 6% here in these coming years. But we did okay. And, in some ways, the reputation that retail has built is kind of a nice little moat, because so many people are skittish about it. It's like, oh, I'm comfortable with apartment buildings and retail's scary. And, JCPenney's is going under. Well, yeah, but those are some of the dinosaurs of the industry. Right. Meanwhile, a lot of food and fitness and fun type of things are explosive in growth. And you look at the dollar stores and you look at the drive-throughs, and they're insane. Their growth will blow your minds if you take a look at the numbers.
Yeah, no, makes perfect sense. And it does help that Phoenix was kind of one of those markets that didn't shut down for too long, if I understand correctly. Yep. So I'm sure that definitely helped. If you had the same thing in LA, it might've been a bit of a tougher thing to go through. But yeah. Talk about, you kind of mentioned that it kind of has this moat around it. Talk about some of the misconceptions around retail.
Yeah, I think, if you read some of the headlines, you hear about these retailers dying or going under, or, being just obliterated by Amazon and e-commerce. And a large part of that is true and accurate. But I think if you take a look at those businesses, it's the folks who really didn't embrace kind of like an omni-channel approach and say, hey, we're just sticking with our brick and mortar approach from the 80s. Well, that's probably not going to make sense. If someone can get it cheaper, the same day or next day delivery, like why wouldn't we do that? And COVID just accelerated that probably by 5 years. And so, you think about that when you're backfilling vacancy or buying a building, like what makes sense in today's market? What are tenants looking for? What are consumer behaviors and preferences? It's like people are gung-ho on drive-through right now. A lot of medical users have backfilled some of the vacant boxes that once existed, or you're taking big boxes and chopping them up into some smaller uses, or the grocery store that gets turned into a trampoline park. I mean, we can go on and on with some of those examples, but it's a deal by deal, neighborhood by neighborhood, and even corner by corner, study when you're looking at those. I'm like, some of those big, deep boxes way set back off the street, I don't love. I'm not out there buying indoor malls right now. It's the stuff that has demand from tenants that are looking to expand right now, where I want to be kind of meeting that demand versus trying to create it. That's a tough thing to do.
Absolutely. And I couldn't agree more. And like you mentioned, indoor malls, those kind of things. Yes, it makes sense why those aren't doing well. But if you focus on what people want, there's a lot of people now who are starting to become, I'm sure as you've seen, a lot more bullish in retail. What are some of the economic indicators you guys are paying attention to in that asset class?
I mean, if you look at single tenant net lease deals, you see stuff in the low fours, even sub 4 caps now. So someone's willing to buy, a Starbucks or a fast food restaurant for a 4% return. I mean, that's so tight. A lot of people probably aren't putting debt or leverage on it. It might just be an all cash purchase, and they might be cashing out of a 6 unit in Orange County where they're getting a 3%, cash on cash return, and going and buying a 4 cap Starbucks in a market like Phoenix, where it's got rent bumps built in, and it's completely, hands off, almost like a triple net or an absolute net deal. So those deals, I think, have become even more desirable and popular because it's so easy to manage, because it's so passive, because you've got, the certainty of Starbucks paying their rent bill for the next 20 years. That's like a coupon clipper. If I flip over to, the maybe multi-tenant class B or C type of stuff, I've seen that come down from like the high 7 caps to the low 7s, even sub 7 cap in Phoenix in a lot of cases. And, folks paying price per foot close to replacement cost, depending on the asset. I've been able to buy a couple deals recently at, 60, 70 bucks a foot, $100 a foot, but I like those because I've got a good cost basis and I can kind of outcompete the stuff around me because I bought it right. So couple things that I'm seeing and feeling.
Yeah, it makes perfect sense. And you talked about obviously like Starbucks and those, of course, not going to miss rent. So kind of talk about now what these leases look like. You mentioned before things kind of vary by area and different things, but are you trying to do triple net with every tenant, or kind of talk about some of those things?
Almost all of my leases that I've inherited have been triple net. There's been a couple deals that I've looked at, maybe in the lower income areas where, the tenant base just doesn't prefer that. They want to see gross leases. They want to know it's $1,000 a month and it's going to have no fluctuation. The buyer pool for most retail investors seems to prefer triple net leases. They want the certainty that, hey, my income is going to be this, and whether taxes, insurance, or common area maintenance fluctuates, like I know what I'm making every year, and a lot of those costs get passed through to the tenants. So that could be a strategy, is to convert gross deals into triple net deals. All of mine are done that way. It's just kind of the best practice, or the typical that brokers are used to working with, that buyers are used to working with, that lenders want to see. And it's nice for us as owners too, to say, hey, we know we're going to be making this much for the next 5 years. And I think to your other question, it's a 5-year lease is probably the minimum we'd want to do. I push some for 7. I think the smart folks are getting into longer deals right now, going, hey, if I can get a landlord to agree to 2 or 3% rent bumps and lock that in for the next 10 years, the tenants are probably beating us on the inflation, which we know is happening at a way higher growth rate than 3%, which is almost the norm for a lot of these leases. So I find myself kind of battling with some of the leasing brokers right now saying, guys, 4% isn't even keeping up with inflation.
Right.
And so that's a whole new thing to think about in this like hyperinflation environment that's maybe more pronounced more than it's ever been, especially in the last year or so.
Totally. Yeah. And I've talked to some people who like to do the shorter term just for that reason. It sounds like you like the longer term. Obviously kind of varies. But on the lender side, when you're taking on these heavily distressed assets, what does that look like? Are they lending on the pro forma? You obviously have a track record now, but what does that side look like?
Generally, the stuff that I'm buying isn't really lendable. Traditional banks don't like it. You're probably going to look for a bridge deal or a hard money loan deal. I've actually done a bunch of seller financing on my last couple deals, and so they'll give me a year or two, 4, 5, 6% interest only. They're making some decent money. I'm increasing the value of the property, and then I can take them out at a refi or a sale. I've been able to forge a couple relationships with like a local bank or regional bank who says, hey, we like you, we like your resume, we like your track record, you've got good credit. If you and your wife and your whole family and you pledge your children, you personally guarantee it, we'll do a traditional loan here, even though this is, a high vacancy, unstabilized deal. Specifically, I just got a 4% interest only loan back in October on a vacant drugstore that we bought. And so that came with 18 months of IO interest only. And, now that same loan today is probably clipped up to 5.25%. But those deals can be had out there. You could look at life companies, the loan brokers all day long can shop a handful of different things and just say, hey, which one is going to be the best fit for me in this deal? And seems like with some of these loan products, you squeeze on one side, it kind of comes out the other. So you're paying for it one way. The banks are going to get their money for sure.
Totally. Yeah. And that's awesome. You were able to make that relationship and they're willing to take on that risk with you. And obviously, your track record kind of speaks for itself, which of course helps a lot. So kind of along those lines, talk about kind of the investor side. What was it like, going out and finding investors and kind of building that investor pool with, pretty risky asset class, and obviously even riskier because it's so heavily distressed.
Right. Double scary, right?
Yeah.
Mine started way back in my house flipping days. So fortunately, I was able to show a lot of friends and colleagues win after win after win, just doing, private money loans, first trust deed. I'm in and out of these houses in 120 days. They're making 8 to 12% on their money. So, win for them, nice passive income stream. Win for me is letting me, borrow a little cheaper maybe than hard money rates. And so a lot of those people were excited to kind of make commercial part of their portfolio as I transition to that part of the business. And I say, okay, guys, here's how this works. Rather than being a debt position on a rental house or a flip, you're actually going to have an equity stake, and just kind of some education around how that works, and the managing partner, and that they're going to be in more of a passive role. And we're not probably going to make distributions for the first year because we're reinvesting into the property and we have a high vacant property. But as we stabilize and as we start to have positive cash flow, and as we build a little war chest in the bank, we can turn on those distributions. And I typically do quarterly in commercial rather than monthly, just because, if there's any inconsistency and not a lot of people are pressing me for monthly, and just a little bit less management intensive that way. You get your quarterly distribution, you get your proportional share of the tax advantages. We're paying down the loan every month, and by the way, I'm signing leases that increase the property, in value at a very predictable amount. So you benefit in all four of those profit centers being combined together. And I think as people understood that, they were, as excited as I was to make that transition into being an equity owner in the property and having an LP position and having great vehicles to help shelter some of their other, taxable income or offset W-2s and, all the wonderful things that you and probably your listeners are familiar with at this point.
Yeah, absolutely. And I love your approach there. Really, it was just about educating them and helping them understand, what it looks like. And once they do, like all things, once people do, then, they usually come around. But it's hard to get people to invest in stuff they don't understand. So it's really important on our side to just educate them and help them understand. And then it's usually pretty easy transition into investors. And obviously, as those returns come and they see it actually working, then there you have repeat investors. And the next thing you know, you've got referrals.
Exactly.
I love it. So we are kind of coming up against time here. I've got 5 questions I ask everyone. It's the final 5. First question is, what's the best advice you've gotten from a mentor?
One that pops to mind and I'm constantly reminding myself of is the idea that, I should be embracing who, not how. It's a book I just read from Dan Sullivan. And
love that book.
The more talented folks that I can surround myself and my team, and whether that be vendors or partners or brokers, attorneys, CPAs, to help support, our portfolio and our growth, and let them do what they're best at, their unique ability, something that they've maybe worked a decade or 2 at in honing their craft. I'm working less while making more, and able to grow and removing ourselves as the bottleneck. And that probably, resonates in real estate and so many other businesses. And it's different than what, I think a lot of us are taught as a kid. And it's like, if you want something done right, do it yourself. And, that'll take you so far. But the level beyond that, if you listen to a lot of these wildly successful folks, they talk about their teams and their companies and their cultures, and the people are really the differentiator that allowed them to grow to, a dimension that just isn't possible on your own.
Absolutely. I mean, we were talking offline about, my team that I have in place for the podcast, and and who, not how was the genesis of that, because I was like, oh, like, of course you think you can do it all. And certainly I could, if I wanted to, but to be successful, you need to understand your unique ability. Mine is talking to people, and I have a great team in place to do the rest. And, that allows me to not only have to do a podcast, I can actually go out and do my real job. So I love it. That's great advice. What is it about your career that makes you feel like you're fulfilling your why?
I like that there's no limits and even no rules, if you want to think about it that way. When I was working in corporate America, it was, and you kind of felt like you had an income ceiling and you had to stay within your swim lanes. And this business, and even, entrepreneurship, building a real estate portfolio, investing in real estate, investing in commercial real estate, like truly as many deals as we want to do and as big as you want to do. You want to do 8 and 9 figure deals, they're out there. You want to do it with a team of 1 or 2, you can do that. You want to build, an incredible company that stands the test of time and outlives us, that's possible too. And, it's a little bit of, gamification, and hey, how well are we playing this game? Am I playing it as smart as I can? Am I, using my time as efficiently as possible? What's the opportunity cost here? No day is the same. And, it's fun that I'm able to, set up my business and our life in a way where, I'm spending as much time as I can on the stuff that I love, that I'm passionate about, that I'm fired up about. You can hear who, not how, and unique ability. It's like baked into me now, right?
Yep.
But that liberates me. That makes me feel excited that, anything is possible. And what's wild too, on the flip side of that, is like, I maybe work a lot less than I thought I would. And I'm not doing as much as I once did. And I got young children now. It's like, oh, I'm gonna spend a little less time, obsessing over the business and trying to grow it, and more time while they're young and home right now, and just being able to be around a lot. And we're fortunate that we've kind of gotten to a place where we can live comfortably, but not have to spend 60 hours a week grinding away, to make that possible.
I love that. That's awesome. And that's great that you've set yourself up to have that luxury now, and you can be part of your kid's life and not miss anything. And that's one consistent thing in this industry, and why I love it so much is really that freedom. And someone put it into perspective so well on an episode I did, where yes, we're of course we want the freedom, but in reality we want the memories, right? That's really ultimately what it is. We want the memories that we're able to create, and pretty powerful. So I love that. What's your favorite non-real estate or investment related book?
I read and reread The One Thing by Gary Keller, who, coincidentally, Keller, he is a real estate guy, but that book wasn't just about real estate. But when there was a few years there of me trying to transition from residential into commercial, man, did I feel lost and frustrated, and how much time and money had I spent in pursuit of deals to never have a payday, and how much was I investing in, coaching and mentorship and running around all these seminars. And just kind of helped me to come back to the idea that, hey, if I get one of these commercial deals across the finish line, it's absolutely life-changing. And it just opens up the doors to so many other things, like freedom, or the ability to hire people, or the ability to take care of your family, or all those things. And you can get lost in the weeds, you can get distracted. There's so many people vying for our attention that almost became like a North Star. It's like, hey, I just need to go out and write offers on distressed commercial real estate. And if I do enough of those offers and I continue to get better at my craft, I'm going to close one of these deals. And it will eventually lead, to 7-figure payday or 6 figures in cash flow. And that unlocks so many more things. And then I can keep going from there, right? It's like that, just getting that first domino to fall was so big. And there was countless times where I wanted to, kind of give up and walk away. And we were sitting here looking, man, is this going to work? Like we're 100 grand into this with nothing to show for it.
Yeah. Yeah, it's so true. But the art of the first deal is such a real thing. It's crazy how it just kind of starts compounding after that. If you could have any superpower, what would it be?
Ironically, I heard Elon Musk talking about luck the other day. That's the best superpower. I don't know, or knowing the future, right? It's like, I don't really know the future, but there's probably some things that we can count on, right? If you knew what you know now, and I think we can bank on certain things like inflation happening and properties probably continuing to go up in value, and the ability to pay down our loans, or think about like some of the big long-term bets that Jeff Bezos made. It's like, look, people are always going to want a good value, right? Good prices. People are always going to want great customer service. And so having the ability to see out maybe a little bit further, and, just know, we kind of do that as best we can, but that would be pretty wild.
Absolutely. I mean, they had a loss for 20 years. Imagine going to an investor, be like, hey, I want to start this company. Just so you know, we're going to have losses for 20 years. Like,
and then it'll become the biggest company anyone's ever dreamed of.
Yeah. And they're like, yeah, okay. I would love to talk to people who he approached in the beginning and who missed out on that. Cause you hear like Gary V missed out on like Facebook early on, and like some of these, but I would love to talk to some of those early Amazon investors who are like, books online, sir, you've gone crazy. Cool. And what's the best way for people to get a hold of you and learn more?
I love LinkedIn because I can instantly see, what everyone's got going on, some of their backgrounds. So definitely please reach out and say hi to me on there, connect. Also, all my, social media and information about me and my portfolio and my business is up on simplifiedproperties.com. So you can jump on there. My buying criteria is up there, how we work with investors, been doing more and more around tenants and how they can lease property and space from us. Our social media is all up there. So I would check both or either of those resources out, and please say hello. Let me know how we're connected.
Cool. We'll link that in the show notes. This has been incredible. Thanks so much. insights into the retail space. We don't get to talk about it too much. Like I said before, I think it's well, I'm sure you enjoy that moat that's been put around it. But again, thank you so much for sharing your insights, and I appreciate your time.
No, I had a lot of fun, Jonny. Thank you. And thank you to all your listeners out there for tuning in.
Thanks, guys. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.